In today's video, I'm going to teach you how to calculate risk in futures in Tradingview. Before we click anything, let's get clear on what we're calculating. In futures, your dollar risk on a trade comes from three things working together. How far your stop, losses from your entry and ticks, the tick value for the specific contract you are trading, and how many contracts you plan to trade. The simple formula is stop-loss distance in ticks multiplied by the tick value per contract, multiplied by the number of contracts. A tick is the smallest price movement for that contract. And every futures market defines both its tick size and tick value. If you are unsure, check the contract specs with your broker or the exchange so you are using the correct tick value. Now, let's put this into action. Open your chart and load the futures contract you want to trade. With the chart in front of you, identify your planned entry and where you would place your stop loss. The distance between those two levels, measured in ticks, is the backbone of your risk calculation. While you can do the math manually, the fastest and cleanest way to handle this in Tradingview is with the position tools. On the left sidebar, open the forecast and measurement tools. Then choose either the long position tool if you are planning to buy, or the short position tool if you are planning to sell. Click to place it on the chart near your intended entry. You'll see three main lines: entry, stop, and target. Drag the entry line to your planned entry price, and drag the stop line to your intended stop loss. As you adjust these, the tool displays the stop distance in ticks, so you immediately see the exact size of the move you are risking. To dial in the dollar amount, double-click the tool to open its settings. Here, enter your account size and the percentage of your account you want to risk on this trade. The tool will then translate that risk percentage into a precise dollar figure, and if applicable, adjust the position metrics so you can visualize your exact dollar risk right on the chart. This keeps your risk consistent from trade to trade and removes guesswork. As a quick example to tie it together, if your stop is 15 ticks, each tick is worth 12.50 per contract, and you are trading 2 contracts, your risk is 15 times 12.50 times 2. The position tool reflects that automatically once your entry and stop are set and your risk settings are in place. That's it. Thanks for watching.